Welcome to At Health and Wealth. Whether you are a seasoned investor or just starting, today we will cover the essential rules that will help you to formulate, improve, or reconfirm your investment strategy. Rule number 1. Do you understand what you are buying? Know the likely risks, rewards, and the impact of external influences. You won't be able to do this assessment without understanding your asset. For example, with shares in individual companies, you need to know what the company sells, why their products are purchased, what their unique selling point is, and what can endanger it. You will also want to understand who their competitors are and whether they have any competitive advantages over them. Once you have figured all this out, the most fundamental question is if the stock is selling at a discount to its future earnings. A good test is to see if you can explain this to someone else. If you cannot, it is a good idea to reconsider buying it or to start looking for more information. This will also help you with rule number 10. Rule number 2. Adopt a long-term approach. Our second rule is simple but crucial. Be in it for the long haul. Investment is a marathon, not a sprint. The value of financial assets can go up, but they can also go down dramatically. The broad stock market almost invariably recovers, but it can take time, and many individual companies within will go bust. If you can't commit and tie up your money for at least 5 years, it might not be the right time to invest. Rule number 3. Accept uncertainty. As discussed in the previous rule, uncertainty is part of the game. While markets usually recover, it's not guaranteed. A lot depends on the exact assets you own. Explore your risk tolerance and reassess your existing or future assets based on it. Being invested 100% in equities is not right for everyone, and your personal asset mix will likely change over time. Rule number 4. Set your goals. Setting clear goals is key. Taking into account rules 1, 2, and 3, assess your finances. Write down the investment amount that you can commit, your time horizon, the expected returns of your portfolio, and potential losses. Honesty here is vital. Remember to have a rainy day fund, usually 6 to 12 months worth of expenses, depending on your situation. This money should not be used for investing, but is to be kept aside for dealing with emergencies. Rule number 5. Diversification. Diversify your assets. Spread your money across various investments. Avoid putting all your eggs in one basket. For example, when investing in the stock market, spread the money across 10 or more companies. Diversify across sectors and geographies too. For both new and seasoned investors, consider passive funds like ETFs and index funds. They are ready-made portfolios with built-in diversification that track major stock market indices like the S&P 500 or the MSCI World. Rule number 6. Beware of fads. Diversify but verify. Fads come and go. Be cautious about investing in the next big thing. Solid investments often outshine temporary fads in the long run. For example, at the end of 2023, Zoom fell out of the Nasdaq 100, thus marking an end of an era for pandemic stock favorites. It had an almost 400% increase in 2020, peaking at $559, while today it trades at less than $72. Often the first company bringing a novel technology to the market does not succeed, even when the technology does. Instead, consider investing in robust assets that are temporarily out of favor. Rule number 7. Tax advantages. Explore and utilize tax advantages. Many countries offer a way of investing that will allow you to use tax breaks and maximize your returns by legally avoiding paying taxes on capital gains and dividends. A widely known example would be the Roth IRA in the USA, but the UK, Canada, and Australia offer similar accounts. Many employers will offer contribution matches into your 401k or pension plan and are essentially a free 100% return on money going into your account. For example, increasing your contribution from 5% to 10% could mean your employer does the same. Over your career, that will add up to twice the amount being invested and growing in your account. Rule number 8. Simplicity versus complexity. Investing can be as simple or complex as you want. For a straightforward approach, consider passive funds that track indexes rather than individual stocks. Funds tracking the S&P 500 are particularly popular as markets tend to rise over time, but keep in mind rules 2 and 3 discussed before. Many people are 100% invested in passive funds. If you are considering investing in individual stocks as well, it is often best to have a core portfolio in a passive fund, then a satellite portfolio of up to 20% where you hold individual stocks. Rule number 9. Monitor investment costs. Costs matter in investing. Do your research and compare fund charges and platform fees or maintenance costs if you're investing in real estate. Understand that seemingly small costs can significantly impact your long-term investment returns. Rule number 10. Monitor progress. Do not obsess, but do monitor what is happening with your returns. Regularly review your portfolio's progress. Keep an eye out for any signs that your investments might not be performing as expected. This is particularly relevant if you own stocks in individual companies. New market information, industry trends, innovation, leadership changes, and a myriad of other factors affect your potential returns. If it seems an insurmountable task, consider passive funds. They allow a more hands-off approach. We suggest applying these 10 rules every time you are thinking of investing in new assets or are assessing your current investments. Whether you're just starting or have years of experience, these rules form the foundation for successful investing. Check out our other video, The 4 Best Return on Investment Habits. If you enjoyed this video, please give us a like and consider subscribing. Each week, we are releasing a new video on improving your finances and your health. Happy investing, everyone!